Good afternoon, friends, and a very happy Diwali to you, your family, and your friends. Welcome to my channel, Tax Journey. Now, why this name? The platform on which I am going to speak, or the platform which I am intending to create, is not the one where only I am going to post videos on subjects related to taxation. I invite professionals who have liking towards tax to all come together and post videos on subjects related to taxation, share their knowledge, their views, and that way we can solve queries and learn and grow together. I also have a website, internationaltax.co.in, which is a blogging website where again I welcome all the professionals to share their knowledge on subjects related to international tax. Now, today's topic is also related to international tax, which is taxation of digital economy. I believe this is going to be a very challenging and a very opportunistic field, especially for practicing chartered accountants for next decade or so. Now, coming back to the topic today, taxation of digital economy. Now, why a separate term, taxation of digital economy, and from where did that term emerge? So, to understand that, we need to understand a bit of background. Now, what these tech giant companies used to do or are still doing is that they are escaping tax, staying within the four corners of the law and yet not ending up paying as much tax in proportion to the revenue which they earn from various countries. And that is just because of the ways in which traditional tax laws are framed. So what I mean by this, to understand that, let me explain the term permanent establishment. Now, permanent establishment, as is currently defined in most of the double tax agreements, is such that it doesn't cover these type of transactions where a company sitting abroad can generate huge number of user base without creating any kind of establishment in the source country. For laymen's or the ones who are not familiar with the term permanent establishment, I'll just take a minute or so to explain. So what permanent establishment means is, until the company is dealing with a country or with the user base of its country, it does not have to pay any taxation in the source country. But the moment it starts dealing in the country, establishes any kind of physical presence in the country, then it moves from with to in, and hence the source country also gets rights to tax those transactions. Then of course there are nitty-gritties as to if it ends up paying double tax, then then its resident country gives the credit for the taxes paid in source country, and so on and so forth. However, the key thing here is, when does the source country gets right to tax that transaction, especially the business transaction? That is when there is a permanent establishment in that source country. However, for digital transactions, without having that kind of physical presence, they can still generate a huge amount of revenue. However, such kind of transactions were not foreseen while drafting agreements, and hence the common definition of permanent establishment prevailed, and which was easily escaped by such industries like Google and Facebook. Along with the structuring which they did, ended up they paying very minimal tax. What we call as effective tax rate was very minimal. That is where the tax authorities world over felt that there was a need to change the tax laws, because it was aggressive tax planning, but still it was within the four corners of the law. So when at such a huge scale, by staying within the four corners of the law, if companies can escape tax, then it is unfair to other companies, other domestic companies, and hence there is no option but to change the law, because otherwise what will happen, there would be huge litigation cost, and still in the end there are very good chances that the company will win. But the laws which were required to be changed, here what we are talking about are international tax laws. So they are not changed overnight. So hence a committee was formed and it started looking into all the areas where harmful tax practices were done. What today I am speaking about is only one of the harmful tax practices. There were many others. So, and various action plans were formed. Out of that, the first action plan was taxation of digital economy. Now, the issue with which they discussed and they recognized was that, of course, there is tax being escaped here, but the resolution which they are not yet come up with is that how much to tax, how much right to give to source country, and the mechanism to tax such transactions. And of course COVID came in between, so what was to be finalized in early 2020 is still not yet finalized. So meanwhile, what happened is that tax authorities felt that until a consensus is reached, they need to get some tax revenue out of such transactions. So tax authorities started making unilateral changes to their domestic tax laws so as to tax such transactions. Of course, the committee also had given its own recommendations which the country started adopting. One of such recommendation given by committee and which India has adopted is equalization levy. Now, what does equalization levy mean? So one equalization levy was implemented by India in 2016 and the second one in 2020. The first one was narrower and applied only to online advertisements. So for example, if a person advertises in Facebook and crosses certain threshold, then 6% equalization levy becomes applicable to him or her. Practically, although the intention was to tax Facebook in such transactions, however, practically what happens is that Facebook adds up that cost to the user and he ends up paying more tax, more overall cost to the Facebook, out of which 6% goes to the government. The second equalization levy is much broader because which is implemented from 2020. That is on sale of any goods or services through e-commerce operator by a non-resident through an e-commerce operator. So what it means is that if a non-resident through any digital platform via e-commerce operator sells any goods or services in India, then 2% equalization levy becomes applicable. Now this is a very, very broad term, and if you read the law as it is written today, it covers whole lot of transactions, because I believe the intention was to tax only digital transactions, which means not only using e-commerce platform, but the goods or services also need to be digital. So for example, if I buy a book through Amazon, but what I get delivered is a physical book, then I believe that is not a completely digital transaction. But if the product itself is an e-book, then I agree that that is a digital transaction. From end to end, it is a digital transactions, no physical goods or services. And then those transactions can be covered in this equalization levy. However, the way it is drafted now, it implies that all kind of digital transactions, even if the goods are physical, but if they are sold through e-commerce operator digitally, then even those are covered. Now this is a very big issue. Second issue here is that whether constitutionally India has a right to tax such transactions, because double tax agreement still has defined the traditional permanent establishment. There are other complications to it. So does constitutionally India has a right to tax such transaction? That is also an issue, because if the same goods are sold physically, those transactions are not taxed. Then just because it is sold digitally, was this the intention of Indian government? The third issue here is on what amount it needs to be taxed. If Indian government is trying to escape the fact that it is not covered in treaty and is trying to tax it as a type of indirect tax, there again a question comes, does India have the right to tax something apart from GST, because that it would mean that on the same transaction two type of taxes are levied. So there are number of issues with the equalization levy, especially because until a consensus is reached and if countries start implementing unilateral tax laws, then there are bound to create tax issues. But it is not only India, there are many other countries who have named it as digital service tax and have started amending their tax laws unilaterally so that they get certain share of tax revenue. While I am not saying that is wrong, but it needs to be looked at from broader angle and also needs to be looked at constitutionally, because otherwise there would be more and more litigations. The topic of today was a very broad and a topic where there are a lot of issues. So I welcome all to share their views, because I have kept it open. These are unsolved issues, and hence I want views of other professionals also on it, so that way we learn together. Thanks. Meet you very soon on the next video. Bye bye.